My foot in the way. So
No, I'm just trying to make
wasn't
sure
trying to play footsies.
It's all good. We can play footsies afterwards.
You're buying me dinner, though. I'm just saying. I'm not easy.
Whatever we got to do. I'm George Paraskevopoulos. I am Director of Business Development for 2DA Analytics.
Hey everybody, Chuck Yates, the Galactic Viceroy, Digital Wildcatters. Hey Evolve, as most of you guys who follow Digital Wildcatters know, we've done a pretty good job on the upstream, hanging out at the rig, showing where barrels come from out in the field. We've done an incredibly crappy job at saying what happens to the barrel then. This is why we're in luck. I drew the short straw. I know nothing about midstream and downstream. So they chose me to moderate this, of course. But here we go. I produce a barrel of oil.
Yep.
It comes out, it goes into a truck, it goes into a pipeline. What happens now?
So, usually at the producer level, they don't really like to mess with pricing. All they really care about is netbacks, because a lot of their capital constraints, or the capital that they've sunk into getting it out of the ground, is almost fixed. There's a little bit of leeway there, but at the end of the day, they usually turn it up to folks that are a little bit more savvy in capturing value down the supply chain, and they really care about kind of a netback model, just essentially the cost that it took them over the course of a few years, and then you amortize that over the barrel production rates that come subsequently after. And then, they kind of just it's got to make sense on a spreadsheet, so to speak, as far as dollars in versus dollars out. At that point, you have, folks in trade desks or, majors, also like, merchants who, deal in shipping or piping, trucking, logistics.
Money center banks, are they trading that too? Or?
Banks used to. They're kind of getting out of the energy space altogether for various myriad of financial and political reasons.
Right.
Back in the day, and I say back in the day, 10, 15 years ago, and the fracking boom, so to speak, was
Right.
coming online, they saw $140 oil on the screen, and they
Right.
thought that it'd stay like that with China demand year over year. That
I drank that Kool-Aid.
there
at
you
one
go.
point.
Yeah. And that only lasted for so long, because we went 145, $50, then we fell to like 30, and then we kind of traded sideways between 110 and $80 for 4 years.
Right.
And then starting in 2014, the roller coaster really started. And so, banks in their models for pricing, prospectively and capital requirements, essentially don't want in anymore.
Yeah, I couldn't imagine wanting to be in front of a Senate panel talking about how you're evil Wall Street and polluting the environment. So
right. So they're
I get
in line,
that.
and there's the political.
So we produce a barrel, we get it to
market center.
Market center. Gotcha.
Yeah.
Tell us what happens then.
From there, it's traded for value. Probably backing up a little bit. Even at the gathering center, or where the producer might just there might be an offtake where the producer kind of gives it to another party that they've termed up supply with. There's varying pipes that are large in capacity. The Keystone XL and Keystone, the smaller, the diminished version is one. Dakota Access Pipeline. There's so many varying lines from all these basins that feed into major market centers, and Houston Magellan's Houston is a big one. Cushing, Oklahoma is probably the biggest. Actually, it is the biggest one in the United States, because it's where the NYMEX paper futures contract settles. But there are a myriad of trade shops, and and they're majors. Some of them are just private equity funded, just ventures, and a lot of it is just money from old traders who were successful, kind of breaking off and doing it on their own. But they essentially have to manage the pricing of getting it to market and capturing value. And blending barrels, a heavy with a light, a cheap heavy barrel with a more expensive light that you just need to sprinkle on to get a spec before you can deliver it into Cushing, Oklahoma. All that takes place behind the scenes before you actually get a price of a delivered barrel for a futures contract. and that happens day in and day out. You know, you talked about the futures curve when we were offline, and you know that has the physical markets also have kind of not a futures curve but a forward curve as they call it, and that will literally dictate, you know, supply constraints because a pipeline might be underutilized. A lot of times, you know, right now with pipes going offline for political reasons, like the Keystone XL, you know, rail becomes, which was big back in 10 years ago, rail is now on front and center as being economical again, you know. And so there are folks behind the scenes who can get it to market and capture value all along the links of the supply chain.
How many times will potentially a barrel trade hands from literally coming out of the wellbore before Southwest Airlines throws the gasoline into the airplane?
Untold. I mean, if it's that one barrel that a vertically integrated refiner produced it on a lease and it made its way to its refinery in the Gulf Coast and then got shipped up a pipeline to New York Harbor to get put on a plane in LaGuardia, then zero.
Right.
And maybe internally, you know, the supply group, you know, sends it to the trading group, which sends it to the marketing group and the refined products group. So internally, there might be, you know, a handful of trades, if you will.
Right.
Or it could be.
But what's real world today? I mean, are merchants literally buying it all along the way?
Absolutely. And not only that, but they're buying it today on paper, even though it's a physical barrel, you know, because the physical markets kind of trade on a 30-day cycle. And they might be in and out, even if it's with the same counterparty, you know, twice for the you know, same delivery point for the same grade of crude oil. It might be in and out 5 times, where they'll just net out at the end of the month, right? So you know, if I buy 1 million from you today, and then I sell you back 500,000, you know, next week, and then I take back another 1.5 million, and then I sell you 2 million next week, you might end up owing me barrels,
right?
Or excuse me, I might end up owing you barrels if that's the case. So I mean, honestly, it's you know, pick a number on the wall by throwing a dart in a wall bunch of numbers, because you know, it's on the order of, you know, 10, 20, 30 times. I don't think it's 1,000 times, but it can be, they're very liquid markets, and different traders and different you know, different companies or trade shops that are at different points of the supply chain, you know, they trade around value, and when value presents and profitability manifests, they close out sometimes to offset risk. It just depends. I mean, and then there's a bunch of personalities in between. So who knows? Is the answer to that question?
Yeah, you know, it's always been interesting to me that we produce 95 million barrels a day today, kind of worldwide, something like that, and yet literally every day on the NYMEX, 1.2 billion barrels trades hands through the various contracts and the like. And so, I mean, just the spectrum of that, and seeing the barrels get from there to refineries and then ultimately in use by folks. I mean, there are going to be 100 different bottlenecks all throughout there with pricings and arbitrages.
Potentially, yeah. So I guess the way to think about it logistically is, once it comes out of the ground, it's either, you know, depending on the location of the lease or the basin, you know, it can just literally come out of the ground into a kind of a tank farm that literally has pipeline injection routes to big gathering centers, or it can be trucked. So that would kind of be the first kind of logistical link in the chain. Then at the marketing center, or the gathering center, it gets put in larger pipes that send it to bigger market centers. Think Cushing, Oklahoma. Think Magellanes, Houston. Think Corpus Christi, via bigger pipes. You know, or up in Canada, right? You know, the big, you know, Enbridge's got big pipes. All the Canadian companies, Keystone, you know, even Plains All American, which is a U.S. company, you know, they all have larger pipes that feed from large basins into market centers. From there, they go to the refinery complexes, whether it's like, you know, the mid-continent in Chicago,
right,
or the Gulf Coast, which is where the brunt of the refining capacity of the country is, about 85 to 90%,
right,
between Texas and Louisiana. And then at that point, when it's refined into gas, diesel fuel, jet fuel, it's put on a few, you know, also equally as big pipes as the ones that we're feeding in out. The largest being Colonial Pipeline, which is kind of, it goes from Houston, Pasadena, all the way to New York Harbor. And that's kind of where the Eastern Seaboard gets their energy lifeline from. So that's why hurricanes affect them all the way up to, you know, parts of the Southeast and even the mid-seaboard, Eastern Seaboard. You know.
So at the risk of sounding really, really old, you know, back in the day, Enron was created around natural gas. And basically, you know, the famous story about Jeff Skilling when he was still at McKinsey coming up with the gas bank, you know, and all you needed was to virtually own the gas to trade it. I think in hindsight, we all figured out Enron had physical assets in natural gas, which gave them an information advantage as well as an operation advantage to arbitrage natural gas, that when they thought their skill was truly trading and they tried to duplicate it in broadband, they fell flat on their face. And literally at the end of the day, their competitive advantage was actual information, not that they were good traders. How efficient is the world today in terms of the spectrum from wellbore or refinery in terms of information, arbitrage opportunities, and the like?
It's gotten better. It probably hasn't scaled up as fast as it should. Owing to your example of Enron, they were definitely front runners. My partner in my podcast, Alex Chandy, and myself, we spoke about that on one episode where, on balance, we talked about, you know, the net good. We didn't diminish the bad that, you know, they were found to have done, but the good that they did as far as working towards, you know, transparency, pricing, and markets was something that was very much a forerunner. That, you know, bits and pieces of that are in the petroleum space to this day. Now it can get a lot better, and that's where density of information, software user interfaces that kind of lay all these multi-factors and variables real time, as opposed to just having piecemeal data feeds, which is kind of the standard now, right? But yes, to your point.
So give me a piecemeal data feed example. I'm a trader. I have a Bloomberg.
I have a Bloomberg that gives me, you know, inventory reports on Wednesday, and then maybe I have a Genscape subscription that, you know, and an API report that gives me the day before to figure out what the expectations are for the actuals. And I have spreadsheets that literally tell me where my position is, my constraints, and then I'm literally taking, I don't want to say a guess, but it is an educated guess, if you will, a hypothesis and a vision of what it's going to do the next day, being in this scenario a Wednesday inventory report. And I'm going to try and position accordingly to my view that real time 10 seconds. But that's really
cool. Are you talking spreadsheet world? This sounds like, oh my gosh.
And it's antiquated, relatively speaking. And this is where you know, a company I'm associated with, and Alex he's a co-founder, 2DA Analytics comes in, because they have literally they looked at the user interfaces of everyday people via Uber, you know, Google Maps, all this, and it solves the question that is fundamental in trading day to day. And it's like you are at a certain location, whether it's you in an Uber app or you have barrels of oil, and then you literally have distance where you want to get or you want to send it because prices, and then you have like logistical constraints, and then price. What is it going to cost me? How much is that Uber ride going to cost? How much does it cost to put it on a pipe, and what can I sell it for at a different market center? And that kind of like real-time data recon or telemetry is missing, in the sense that they're only fed to you in piecemeal, and you have to reconcile them a lot of times on a sheet, which can't give you that visual, geospatial, like intuitive topographical lay of the land. and that's where I think.
I mean, this is almost like how Warren Buffett. It sounds like how Warren Buffett picks stocks versus everybody else in the real world running algorithms, trading, shaving, umpteen seconds off of each trade for. So along this chain that you were describing in terms of the wellhead going to the refinery, how volatile can pricing be along there? And maybe give us an example or two. Because I know as the producer, there are days I'm getting WTI minus $1. There, 6 months later, I'm getting $5 above WTI. There are times, I mean, in the Bakken at one point, we were getting $30 below WTI on stuff. So walk me through what happens there.
So that happens due to logistical supply constraints. I mean, owing to your example of negative 30 WTI, I mean, the reason why that happened is because rail was the only, at that point in time, that you could, it was the only way you could get it. The pipes weren't online, so you had to either truck it, which is prohibitively expensive unless it's not, and then the cheaper on the logistical supply chain. If trucks are more expensive, rail is next, and then pipes are probably the cheapest and the most efficient. So and this is what happened when these open seasons for these pipelines came on. It made all the sense in the world. If you had Bakken production and there was a $30 ARB to the coast, and you were railing it maybe to the East Coast, then it made all the sense in the world to essentially sign on a take or pay for a pipeline. And back in older eras, those loops of the ARBs or arbitrage opportunities closing, all ARBs close, as traders say, but the timeliness of it closing was probably a little bit longer because of the information didn't pass readily or logistics didn't come online as fast. That cycle of ARBs closing is going to get faster and faster to the point where even on the physical side, we're not talking about negative 40 WTI on a screen going to $60 and some change today, over the course of a year. We're talking about committed pipeline shippers doing something with a 5-year, forward forecast. And in 6 months, COVID happens, and now demand just gets turned on its head. Cactus is a prime example where there was $10 from the Permian Basin to get it to the coast of arbitrage opportunity. Well, when you have demand, refined products demand or energy demand fall off a cliff by 30%, that goes away, and you've committed to that. So real-time pricing information, is going to be, and real-time like market intelligence, supply, demand, pricing, and then logistical constraints thereof are going to be huge, but you can be inundated with so much data that you can be paralyzed. Analysis paralysis, as folks say sometimes. So having software user interfaces that allow you to see the topographical supply and demand lay of the land with pricing overlaid and other sort of like experiential things that older, wiser traders might know just intrinsically because of their experience, that can all be conveyed and conferred via software nowadays, and to where, when the next group comes in, they can stand on the shoulders of giants. They don't have to relearn how to invent the wheel, so to speak.
Does artificial intelligence come into play here?
Somewhat. That's a little bit, that might be getting a little bit ahead because, AI can't recognize streetlights yet,
Right.
so to be able to reconcile, I mean, could it get there? Yeah. Right now, where the logistical the bottleneck is the human person, the human being able to interface with all this data and literally just having it kind of blasted on spreadsheets, which is not intuitively reconcilable. Having a user interface where software literally shows you pipes and then little arcs of green arbitrage opportunities versus red gives you a lay of the land to where you can intuitively see something like you would maybe negotiate a mountain pass because you can see where the peaks and the valleys are.
That's interesting, because that was going to be kind of my final question, thinking it through, is more transparency, better information for the traders. What does that ultimately mean for the traders? But then what does it ultimately mean for me, the producer? Does that mean better pricing, less volatile pricing?
What it's really going to mean is that the middlemen in the supply chain, so there are folks who just trade, don't have production, and they don't have refineries, or they don't have convenience store chains or farmers to sell the gasoline or the diesel fuel to.
Right.
But they literally, they are a link in the supply chain because they know how to maximize a tank asset, or they got pipeline space and they can trade around that. And like I said, the producer who deals on the netbacks, they just want to sell it at a market location for a set amount of a formula price and be done with it. They're going to be able to, those bookends are going to be able to play, and they're going to cut out a lot of middlemen. And so that's going to cause pricing transparency. It's not going to go hiccup free, but the smoothness of the pricing is going to be much more pronounced. Distortions are always going to exist. People are going to over leverage and try and maximize something for greed reasons or fear, and opportunities are going to present. But the smoothness, if you will, is going to be much more pronounced. The transparency, and it's going to. I think it's going to manifest in much more smoother pricing day to day.
That sounds like that's going to have ramifications.
Absolutely. At the end of the day, the old paradigm and way of doing things is over. There's software, user interfaces, and a group community of thinkers that are ready to essentially lead the vanguard and shatter the paradigm, as I like to call it. It just depends on a critical mass of forward thinkers and initial adopters who kind of have the balls to actually take the first step. So, we're today with my podcast and my partner Alex's podcast, we're trying to find those folks. We found him here in Digital Wildcatters, and we're looking for folks that also kind of have the gall to step up and take it into the next era.